Good afternoon, and thank you for joining us today. My name is Timothy Lee, and I'm a research analyst at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on iron ore and also some vanadium exploration and development today. We will hear from Sean Cleary, CEO and Chairman of Strategic Resources, Inc. During today's webinar, he will provide an overview and outlook, and then we will take questions. You can type your questions into the chat box at any time, and we will get to as many as we can. Before we kick things off, first we need to discuss some fine print during this Strategic Resources webinar. Forward-looking statements may be made. I would direct listeners to the company's forward-looking statements disclosure outlined in the strategic corporate presentation, and that can be found on the company's website, strategic-res.com. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors, and participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures pertaining to strategic resources. So we have Strategic Resources presenting today. The company is primarily focused on advancing its vertically integrated iron ore project in Quebec, including a large iron, titanium, vanadium deposit and downstream processing facilities. As well, the company has a past producing mine in Finland. With that, I now turn it over to Sean to update our audience on the company.
Good afternoon, and thank you, Tim. Yes, Sean Cleary. I'm CEO at Strategic Resources. As Tim mentioned, we are focused on the green steel space in Canada, and we also have assets over in Europe and Finland. And the symbol is SR. The ticker symbol is SR on the Venture Exchange in Toronto. This is the forward-looking statement disclaimer language for the presentation. And as Tim mentioned, we're focused in Quebec on our flagship, the Blackrock project. We're the developer of the Blackrock project in Canada. It is a project that is focused on supplying and servicing and providing solutions for green steel space, both in North America and Europe. That is our focus. The first step of the Blackrock project is the development of the iron ore pelletizer at Port Saguenay in Quebec. Our focus is to build out a 4 million ton per year iron ore pelletizer that will produce DR grade, so direct reduction grade, iron ore pellets and service the markets in North America and Europe. There we have a picture of the wharf at Port Saguenay, where we have a long-term lease. So Port Saguenay has excellent access to those different markets that I mentioned, whether it be down into the Great Lakes. We can load Lakers at Port Saguenay and supply into the Great Lakes, as well as up to small Cape-sized vessels can be loaded at Port Saguenay on the existing wharf to supply, whether it's the Gulf of Mexico or into Europe, Middle East, etc. And, really it's excellent access to the steel manufacturing regions that are focused on transitioning to electric furnaces. And that's really where we're focused because at Port Saguenay, we can produce a very low CO2 product that is well suited for the electric furnace steelmaking market in these markets. So this is a schematic of the iron ore mining and production scene in the province of Quebec. So at the top right of your screen, you have the major producers within the Labrador Trough, cumulative approximately 70 million tons of iron ore production in that area. We're located further south down at Port Saguenay, sort of in the middle of your screen there, where we're going to build out the metallurgical plant part of the overall Blackrock project, starting with the 4 million ton iron ore pelletizer. We have also a permitted open pit mine and concentrator at our mining claims up in Chibougamau. And it is our intention over time to build out and have a fully integrated operation with the Saguenay plant. So the way we see developing the Blackrock project is in 3 phases. So phase 1 will be a merchant operation pellet plant. And our focus on this plant is to produce what we call DR grade. So these are very high purity iron ore pellets that are used for steel making in the electric steel making type of plants. And our intention is to produce up to 4 million tons per year from the iron ore pelletizer. And we'll sell these DR grade pellets into the markets for electric steel making. And the reason we're focused on that is because there's a big deficit in that market, which I'll talk a little bit about. And we're hoping to solve issues for steel makers that want to transition to green steel and electric steel making. In phase 2 of the project, we envision installing our own direct reduction furnace, and we'll be able to produce either DRI or what they call HBI, hot briquetted iron pellets, and they will be sold into the steel makers as well. And then in phase 3, we would envision developing our open pit mine and concentrator at Chibougamau and being able to supply that feedstock into the pelletizer and metallurgical complex as it's being built out. We'll be able to produce at that point both the pellets, DRI, as well as pig iron, and some vanadium titanium products as well. So some ferroalloy products, all of which are used for high-end steels. And this is the market that we see the greatest opportunity for. So for the overall project, we completed a full feasibility study, 43-101, in November of 2022. And at that time, the CapEx was estimated at $1.5 billion Canadian. And, our overall project design was to build out both sites at the same time. And in the intervening time period here, we thought about, well, how do we build out this in a lower risk, easier way? And then we've come up with basically the phase 1 approach with phase 2 and phase 3. So phase 1, we're looking at CapEx of $470 million US, and that's what we're focused on today. As I mentioned, there's a number of products that we want to eventually produce at the Port Saguenay plant. In phase 1, our production will be 4 million tons of iron ore pellets per year. These will be DR grade. And this is a chart, what you're looking at here is a chart of the value chain of iron products going towards finished steel. So in phase 2, we would like to forward integrate the plant and install a DRI furnace, which we've already permitted. And we can produce 800,000 tons of DRI or HBI per year, which is a much higher value, higher margin product than just simple iron ore pellets or simple iron ore concentrate. And then in phase 3, once we have the fully integrated operation up and going, we'll be able to also produce merchant pig iron as well as high purity pig iron. So these are between the DRI, HBI, and pig iron products, the 3 main ingredients that are required for electric furnace steelmaking. And I just take a minute to talk about what's going on in the steel industry in terms of its transition to electric furnaces, and what's driving that is a reduction of CO2 emissions globally. So as everybody knows, there's a big push by governments, Western governments around the world, to reduce CO2 emissions. And the steel industry currently produces somewhere between 8 and 10% of global CO2 emissions. So the idea is to transition old technologies in steel making, whether it's blast furnaces or other types of furnaces that are highly emitting, to lower emitting electric furnaces. And when that's done on a single site basis, you're essentially reducing carbon emissions within those steel products by about 75%. So, from a government policy perspective and from an industry point of view towards getting greener, this is very low-hanging fruit. And we've seen governments around the world, including recently the Canadian government, investing in this transition to electric furnaces in the steel industry. In fact, I think the Canadian government has now invested over $1 billion Canadian dollars into these transitions within the Canadian steel plants. And overall, it's important to understand that, old technology blast furnaces, they typically would use maybe up to 25% of scrap steel in their steel recipes, whereas electric furnaces are really built and originally designed to produce steel out of scrap. And so a typical recipe in the steel making market would be about 75% or more of scrap in the recipe for making steel. And what's going on is a major shift in terms of supply of scrap, and especially prime scrap, because there's many different grades of scrap. Prime scrap being typical scrap that's coming out of industrial waste, like steel from auto plants and other types of manufacturing operations, all the way down to scrap that is just residential scrap that's brought into the scrap yards. So and there's big differences in these grades of scrap, and as there's going to be many more electric furnaces in the steelmaking market, it is expected to lead to a scarcity in what is considered prime scrap. And that means that there'll be a lot more contaminants in the scrap supply overall. And the solution to reducing contaminants and allowing steel companies to make the spec of product that their customer wants is pig iron, HBI, and DRI. So direct reduced iron, hot briquetted iron, and pig iron, which are used to basically dilute out those contaminants in the steel making process. So this is very important, and there's a significant overall deficit expected on the market, and a lot of investment going into DRI, HBI, and pig iron plants today. And BlackRock, the overall BlackRock project, will eventually produce all the way up to high purity pig iron. So we want to be a solution provider in this market, and on an integrated basis, the overall BlackRock project has demonstrated that we could produce a very, very high quality of pig iron, and as well a high quality of DRI and HBI, and as well iron ore pellets. So this is our focus, and this is where we're headed. And of course, pig iron and these other what they call ore-based metallics, HBI, DRI, are in high demand, especially in the U.S., Japan, and European Union, as these areas go fully electric. And this is a major shift in supply flows, material flows for the steel industry. And it's expected that we're currently running globally about 30% of steel plants are electric. It's expected that by 2050, around 50% of steel production will be electric. And that means something in the order of 1 billion tons a year becoming out of electric furnaces in the steel industry. And that's a major shift in terms of tons, supply, material flows, etc. And it would mean that there would be a big deficit in the pig iron HBI DRI market. And again, that's why we're focused on this market, because it's an exceptional opportunity to be a major supplier into the steel industry. So this is a snapshot of the direct reduction pellet market. Essentially, pellet premium chart on the right, showing that, currently pellet premiums for DR grade pellets are ranging around $55 a ton, recently as high as $70 a ton. But the overall market in terms of iron ore feed production is expected to grow significantly to provide for the deficit that is expected across the industry. Something like 20 to 40 million tons of DR grade pellet deficit is expected in the next number of years. So this is why we want to focus initially on the DR grade pellet part of the market, because that's where we see the greatest need in the least amount of time as this transition takes place over the next 25 years or so. And we do have some significant advantages based on where we are. In Quebec, we have low cost power. We have a long-term existing lease at a deep sea port. We have significant government support, both federally and provincially. We've recently seen the federal government of Canada and the provincial government of Quebec co-fund $111 million conveyor facility that we will use for our project to take feedstock, iron ore feedstock, from the wharf up to the pellet plant and take the pellets back down to the wharf. So, that's significant support from the port, which is, Ports Canada port. So this is a public port. There's the development of an industrial park at the port. We're the major leaseholder at the industrial park. We're the first permitted project at Port Saguenay for the development of this industrial park. We do have a very nice four-season port here. Can take up to Cape-size vessels. The storage capacity at the port is adequate for the project, and there's going to be more and more investment and development at Port Saguenay in Quebec. So it's an exciting opportunity because this port is currently running around 20-25% of wharf capacity utilization. They want to grow, they want to expand. It's an interesting port because you can load Lakers and supply down into the Great Lakes at this port, as well as large vessels for supplying, whether it's the Gulf Coast, Europe, or the Middle East type markets. Actually, I'll just go back. One other very, very important point is, and I mentioned this at the outset, but at Saguenay, we have access to natural gas. This is not available in other areas of the Labrador Trough, and that's a significant competitive advantage because in order to make DRI or HBI or clean green pig iron products or clean green low carbon iron ore pellets, you need access to natural gas, and this is not available in the Labrador Trough. So it gives us a significant advantage, and it gives us the advantage of being able to produce products that are the low carbon footprint products that are really going to be desirable for making green steel, but also just, for automakers and other end users of finished steel products that are really looking at the life cycle analysis of what's going in and what the footprint of their inputs going into their plants are. So it's a really exciting opportunity to take advantage of a great situation that we have at Port Saguenay. So just some numbers in terms of the phase one pelletizer capital and operating costs. And based on the study that we completed earlier this year, initial capital costs at $470 million US. We have low cost in terms of operating costs per ton, estimated just over $16. So, this is very exciting. especially when you consider the premium that is being obtained currently in the market for DR grade pellets and what's expected to come in terms of the deficit of supply in this market, we can really fill the hole. And how we based our thoughts around, the size of plant and amount of production, et cetera, if we can solve for, a small percentage of what's going to be a growing market in the steel industry, that's really what our strategy and focus is. In terms of the company itself, so strategic, as I mentioned, we're listed on the Toronto Stock Venture Exchange. The symbol is SR. We currently have 63 million shares outstanding on a fully diluted basis. So market cap just under 40 million Canadian dollars. We're well sponsored. We have some, very big investor groups that include Orion Mine Finance out of New York, Investissement Quebec, which is the investment arm of the province of Quebec. Ross Beatty, Lumina Group are shareholders, the Cree Nation, as well as, we have a lot of interest and there's a lot of excitement and news that is starting to flow around investment opportunities in the green steel space. And that's where we fit. That's, squarely what our focus is. And that's what we want to do going forward, is build a great company in that space. And so over time, the big picture is to build out the mine and have an integrated operation. We are, we've got a high purity pig iron overall project focus and some great synergies and opportunities to be able to produce not just the iron products, but also ferroalloy products, which are very interesting for the steelmaking industry, same customer base. Overall, the entire Blackrock project, from start to finish, based on the 43-101 that we published in November of 2022, has almost 2 billion Canadian dollar NPV. So it's very interesting. First quartile on the cost curve for all the products, and it doesn't account, these numbers don't account for our secondary project, which is in Finland, which is a former Mustaverin mine, which used to produce almost 10% of the world supply of vanadium. So, this is also a very interesting project because it has as well iron ore byproducts in that project. So, overall our focus is iron, but the ferroalloy space is also very interesting, and we think that's going to grow as well and gives great upside for shareholders. And as I mentioned, as I went through the presentation here, the overall Blackrock project is fully permitted. So we have a permitted open pit mine and concentrator at Chibougamau. We also have a permitted pellet plant, DRI plant, and electric furnace operation, what we call the metallurgical complex at Port Saguenay. What we did last year was we shifted and expanded the potential capabilities of the pellet plant. So we went back with the engineers and redesigned part of the pellet plant to scale it up from 1 million tons a year to 4 million tons a year. So we've been going through that process. So that part of the process, we are currently require a modification of our existing decree. And we're going through the process with the government to get that modification. But as I've mentioned, we are, very well sponsored overall. And last week announced the project financing lead in Société Générale. So we'll be working with them to move the project forward on the financing side. And this is just zooming in on our mining claims up in Chibougamau. So what we permitted there was initially a 39-year mine life open pit mine. And we've also permitted the concentrator up at Chibougamau. And we have drilled off additional section there so that we could have eventually a second pit but we did not put that in the 43-101 study. So, but basically this open pit mine up at Chibougamau is really a generational asset. We think that, it's got a very long mine life. The ore body itself is, very, very significant. It's outcropping everywhere. So it's an excellent mining situation. We're just outside the mining town of Chibougamau, where you have really, exceptional infrastructure for the development of mining operations in Quebec. We're in the James Bay territory, where we have a long-term impact benefit agreement with the Cree Nation government, who are also shareholders in the company. We also have development agreements in place with 3 different bands of Innu Nation. So, from an ESG perspective, this project really checks all the boxes. And, when we went through permitting, both for the open pit mine and the concentrator, as well as the metallurgical complex down at the port in Port Saguenay, we had no objectors to the project. Almost unheard of for a project of this size and scale, in a first world nation. And with all of the environmental, hurdles and challenges that one would expect, we've been able to work closely with our stakeholders, local communities, groups, etc., and have, a very good relationship with all of these folks moving forward. And so this is the process flow for the open pit mine up at the top. It's a magnetite deposit, so it's a vanadium titanium magnetite deposit that we own up at Chibougamau. So it's really a simple open pit, crush, grind, magnetic separation to produce a very clean concentrate, which we would take by rail down to Port Saguenay, where over time we would develop the balance of the metallurgical plant. So initially the pellet plant, so the balling induration furnace and producing fired pellets. Then in the second stage, installing the DRI furnace. So we've already permitted the DRI furnace. So it would be a HYL Energeron direct reduction furnace that we would be installing there to produce DRI and HBI. And then open slag bath furnace, so an OSBF style furnace, which is really at the cutting edge of low CO2 footprint furnace production for iron products. And, we view ourselves as a leader in this area. And again, we've worked with Tenova on the development of this part of the project to be able to produce a titanium slag, which is a commercial product, a vanadium slag, commercial product, and also produce casted pig iron for the market. So that's the overall Black Rock project, from the open pit mine all the way through to the wharf of the finished product. And these are the feasibility numbers that were published in November of 2022. 39-year mine life, $2 billion after-tax MPV 8, about just over 18% IRR on the project. 3 very interesting products that are in the first quartile on a cost basis, and really producing, significant revenue of something like $800 million a year, and EBITDA in the just under $500 million range per year for the overall project. That's after phase 1, phase 2, and phase 3 implementation. So super exciting. And the thing about this project, it's got some expansion opportunities. I mentioned the ferroalloys, so on the vanadium side, on the titanium side as well. Also, because we have a very large, significant deposit, there's the potential to double production over time, and as well, in time, potentially integrate the Finland operation with the metallurgical complex that we're going to build at Port Saguenay in Quebec. So really some interesting opportunities to build out a very large company. And I guess with that, we'll end the presentation. There's Tim coming back on. So thank you.
Great. Thank you very much, Sean, for the informative presentation. We will now start the Q&A portion of the webinar. A reminder to everyone on the line that you can type your questions into the chat box at any time. We already do have a few questions. Could you please describe the permitting process specifically for the pelletizer plant?
Yes, so we're using our initial permits that we have for the metallurgical plant, which have been issued. And what the government of Quebec, so these are provincial permits, what the government of Quebec has requested is an application to modify the decree that we have. So we're going through that process right now. We have a little bit more engineering to do in order to provide all of the information that's required for the modification of the permit, but that is basically ongoing. And I think overall, timeline-wise, we expect that we can complete that before the end of this calendar year.
Okay, great. Can you tell us a little bit more about the specifics of the arrangement with the Port of Saguenay and how your project fits within the greater plan there?
Sure. So Port Saguenay is a federal public port, so it's part of Ports Canada. And in partnership with the port, so the federal government, the provincial government and the municipality have built the beginnings of an industrial park that is located about 1.5 kilometers from the wharf. And as part of the development of the industrial park, the Canadian government and the provincial government have funded a conveyor system that is currently under construction that will convey materials from the wharf up to the industrial park and back down. And so we intend to utilize the conveyor system for the development of a merchant pellet plant in phase 1. We have a long-term lease in place within the industrial park zone for a significant portion of the industrial park. And that lease is with the Port of Saguenay. Does that answer the question, Tim?
Yep, I believe so. Now, recently you did announce a lead bank for the debt portion of the financing for the project. How overall do you see the other components of the financing for the pelletizer plant coming together?
Yeah, so we announced last week that we'd engaged with Societe Generale as our lead on the project financing for the debt portion to raise up to $300 million US, which would give us a balance of $170 million US that would be required in addition to the SOCGEN piece. Our vision for that is that we would have participation in equity and equity-like funding coming from our existing shareholders, as well as some additional institutions who have shown potential interest in funding the project at this stage.
Okay, great. One question here that's looking at the material that you'll probably be sourcing will probably come from banded iron formations and that are more typical out there as supplies of iron ore. When you do look ahead to potentially supplying from your own mine, will there need to be changes in the processing plant to accommodate the different type of material that you have?
Potentially, yes. It's unknown at this time because we're currently working on the offtake arrangements for the supply of the pellet feed and the offtake of the iron ore pellets that we'll produce with that feed. And because that has not been completely completed, those negotiations have not completely been completed, we're not sure exactly today which type of iron ore concentrate will be sent into Saguenay. So until we have that question answered, I can't really answer the second question, which is, will that require modifications to the Metso plant? Metso is the equipment supplier for the pellet plant. But there is going to be testing that's done a little bit later this calendar year, once we get closer on the feedstock agreements and the offtake agreements. Metso will be taking those materials and testing them at their facility to, just to finalize the engineering of the requirements for the pellet plant. And based on those tests, there may be modifications that are then requested once we move to a more integrated operation.
Okay, great. And one question that I had, we spoke a little bit before the webinar, but looking at, you mentioned Metso as the equipment supplier for the pelletizer plant, and you're looking at finalizing, choosing, I guess, engineering firms for kind of the final work. Are there, our investors, our listeners may be used to investing in the mining space. Will they be familiar names of engineering firms that work already in the mining industry, or are there different specialists, I guess, for iron ore?
They are sort of the typical names that you would see for big mining projects, especially in Quebec, where we have a, very well developed market for developing and building out mining and metallurgical plants within Quebec. So, I think investors will know all of the names that we're talking to right now. We do have a little bit more engineering work to do as we move forward with the pellet plant. We expect to complete that engineering work around January, this coming January. And that engineering work is expected to include all of the construction plans for the development of the pellet plant, which is expected that will be done on an EPCM basis, so a turnkey basis for the company.
Okay, great. Now, we did have one question come in that is sort of related to what we'd said about, whether you need to retrofit. It does say the 2023 feasibility study outlines production of a 62% iron concentrate from the mine. But the PFS level study now in 2024 outlines using a feed of DR grade 67% iron for the pelletizer. Would there be some changes needed to make the Blackrock iron ore suitable to the pelletizer?
Yeah, so this is a great question. It's kind of a follow-on from that other question about will we have to modify the plant once we do the fully integrated? Because the question is correct. So the concentrate grade of iron coming out of the Chibougamau open pit mine owned by Blackrock is expected to be in the 62% iron range. It will be about 1.4% vanadium and have about 9% titanium in that concentrate. Okay, and that concentrate can be converted or processed into three different products: the pig iron, the titanium slag, and the vanadium slag. So, and the process that we're doing that is basically the same process in terms of pelletizing, direct reduction, and then a further step of hot metal into an electric furnace and a converter furnace, and to produce the ferroalloy products. So that part of the process, the end stage of the process, for sure is different. The direct reduction and the pelletizing, there shouldn't be any change to the direct reduction. For the pelletizing, there may require modifications because, one, the iron content is lower, and we do have some other materials in. So that's to be determined in some of the engineering that we're going to do going forward. But what I would say to investors is that we're very much focused on producing, in the first instance, that 67+% iron pellet product, because that's what the market wants. Okay, and that's where we see a great opportunity to feed the market with what the market wants. So, and that's why that's lower capex, it's higher returns in terms of potential IRRs, we believe, and it's more immediate market demand. So that's why we're really focused in that part of the market. And then, the idea to be able to have a fully integrated operation over time, which is what you really want to have when you're, as an iron producer, you want to be fully integrated. So that's our over a longer term period vision to be able to build out the Chibougamau operation.
And one kind of general question, a little bit about obviously the steel business in general, and from iron ore producer through processing to steel producers. Who typically does the pelletizing work? Is that more often a steel producer, or is that at an iron ore mine?
In terms of an integrated operation, it's more typically the iron ore miner, so more of the miner side of the business. But we do see many more merchant operations or joint venture operations in the pellet production world globally. And we believe we're going to see more and more of that because there's expected a very significant deficit in the pellet market. But the simple answer to the question is it tends to be the mining side that does the pelletizing.
Okay, great. One question that's always popular, a little different and on the corporate side, but how much cash do you have and how long will that last with current plans?
Yeah, so we have about 4.9 million of cash on the balance sheet, including, what prepaid things that we paid, etc., at the end of March. And then we also have restricted investments of 4.3 million. In terms of, our sort of base case budget, that takes us out still for, well past this fiscal year. Our fiscal year is June. So well past, June of 2025. And meanwhile, we're working on the project financing. And we expect, from a timeline perspective, to be into construction in 2025.
Okay, great. Maybe one final question here. Obviously, you're focused on the project in Quebec, but you do have the project in Finland as well. What are your plans for that project? Is there work being done there in the near term, or is that primarily sort of to eventually be in the pipeline?
Yeah, it's a great question. The Mustavärin mine is currently on care and maintenance in Finland. And we do have a country manager located in Finland who's charged with that. We do see great opportunities. We've had interest on the project from the EU and other areas. There is a current study being done in the EU on especially vanadium supply, and having a EU-based vanadium supplier. So the Mustavärin project would be one of only two vanadium projects within the EU that are known. And of course, there's been great sensitivity because most of the EU's vanadium supply traditionally has come from Russia. And with obviously the tensions between European countries and what's going on in Russia, as well as, secondary supplier traditionally for the European market has been South Africa from a vanadium perspective. And the South African vanadium producers are under a lot of pressure these days. There's a couple of companies that are public and have, going through great difficulties financially and otherwise in the South African market. So I think the EU is waking up to concerns about how they will supply their future vanadium needs. And of course, vanadium is very important because it's a ferroalloy used in steelmaking. And basically 1% of vanadium in your steel recipe will double the tensile strength of your steel. So this is used from rebar, structural steels, steel rails, automotive parts, etc. So that's very important to the European market, as well as there's a growing demand for vanadium in the battery space, and large storage vanadium battery storage facilities to service solar and wind, which is again a big part of the EU's plans going forward. So so we'll see. Right now, as I mentioned, the project's on care and maintenance, and we'll see what the future holds.
Great. Well, I believe that's all the questions we have today. So I'd like to thank Sean Cleary for presenting today. And thank you, everyone on the line, for tuning in. Red Cloud Securities will be back next week when our webinar series continues with F3 Uranium presenting Tuesday, July 30th at 2 p.m. Eastern Time. Have a great rest of your day and happy investing.